All right, morning everyone. Welcome back to our morning kappa at 8. I'm Joseph here. So looking at the Hang Seng Index, last Friday, the Hang Seng Index experienced renewed selling pressure. Right, according to the Wall Street Journal, the U.S. Commerce Department is contemplating to impose a new tariff on those U.S. semiconductor companies to restrict them import the semiconductor parts from other countries, but they will get exemptions as long as they have a manufacturing plant in the US. So this latest semiconductor restrictions rule called to one-to-one ratio. It actually impacted sentiment in the Hong Kong market, especially the tech stocks. So last Friday, we do see that quite a few semiconductor players have experienced strong selling pressures on the Friday. Nonetheless, overall, technical setup remains bullish as long as the Hang Seng stay above 23,800 point level. The last Friday, we did had review sessions with our CIO, Tan Chi Tun. So if you missed the sessions, do log in and replay this video to learn about the thought process of the one of the award-winning fund manager that manage the okay. And so for Hong Kong market, I'll continue to focus on two internet company, which I think they will drive the AI team. Firstly, the Alibaba. So looking at Alibaba, it underwent two corrections, Thursday and Friday. However, very strong support expected to be at 140 level. And then on second, internet giants will be the Tencent stock code 700, where you can see that based on the price volume profile, a very strong support is somewhere at 600 level. So if Tencent underwent a very strong corrections, a very deep corrections, then you can see that under this price volume profile, the strong support is at 500. But for immediate term, I think that 600 will be a very strong support for Tencent. As for this morning, I'll be looking for the index to stage a counter trend rebound, boosted by these two heavyweight counter. Firstly, 6862, Haidilao International. The counter is eyeing to rebound above 13 Hong Kong dollar. If breakout happen, Haidilao will be climbing towards 13.50 and followed by 14 Hong Kong dollar. Downside support is 12.45. Secondly, we have 2319 China Mengniu, which also testing their resistance at 1490. So if breakout happen, China Mengniu will be having a counter trend rebound towards 15.50 followed by 16 Hong Kong dollar. Downside support is 14.25. Right, and last week the Europe and also the US market are moving sideways. During these sideways consolidations, I think if you are keen on the following the US S&P 500, you can actually look at the ETF, which is the SPY. So right now, looking at the US, this S&P 500, last Friday it did stage a rebound and holding well above the 6,006. So if it continues to stay above 6,006, XPX will be climbing towards 6,850. So downside support will be at the 6,006 and followed by 6,350. So as for the US stocks, firstly, we'll be looking at Intel, INTC. You can see that the Intel, based on this price volume profile again, right, quite a strong or a lot of volume have been traded at below the 25 US dollar. So this could have been a multi-month base for the Intel, and after the breakout, you can see that on the upside, volume are quite thin. We can safely say that the resistance should be weak, and the Intel likely to move a higher high until it form interim resistance. I think on the upside, resistance probably will be at 44. So on the downside, the support will be at 30 US dollar. So another US tech related company would be the Lam Research. We had made trading stocks a report on Lam Research about 3 weeks ago. So right now, the Lam Research has been going on a bullish trajectory. So for immediate term, it's consolidating at about 132. So if breakout happen, Lam Research will be climbing towards 138 and followed by 145. So downside support is about 125. As for the local market, FKI remain on the bullish areas, and the FKI should be heading towards a 1620 and followed by 1675. Support is marked at 1535. And last Friday, the FCPO underwent a fresh negative sessions. Nevertheless, we still keep a bearish bias on the FCPO until it can climb above 4006. So this morning, we'll be reviewing two stocks that we have posted in our trading stock report. Firstly, we look at EcoShop, right? Last week, we did mention about EcoShop about to break the 1 ring and 40 cents. And true enough, the EcoShop have break the 1 ring and 40 cents and right now heading towards 150 and followed by 155. So one thing is that you can actually trade on the mother shares. Secondly, you can actually look at other instruments that RHB provides to you. The other thing that I would just want to highlight is that you can actually look at the core warrant that actually shared by Vanessa. Looking at this EcoShop core warrant, it has actually went up by 40% over the course of 3 days, right? Just continue to follow on our this morning kappa. Okay. Then on this morning, I'd like to share another consumer-related counter, which is Mr. DIY. So looking at the Mr. DIY, you can see that this counter is a very defensive counter, and using the price volume profile, what we do see is that the Mr. DIY have penetrated into the resistance zone of 1 ring and 62. Right. So if the breakout happen, this DIY should climb towards 1 ring and 70 and followed by 1 ring and 75. Okay. So on the technical perspective, I think upside breakout is very likely on the Mr. DIY. For our trading stocks this morning, we'll be looking at the firstly high mobility that right now is consolidating at 2 ring and 40 cents. If breakout happen, high mobility will be climbing towards 2 ring and 55 and followed by 2 ring and 65. Downside support is 2 ring and 30 cents. Secondly, we have the PIE industrial. It just crossed above the 3 ring and 20 cents on the bullish breakout on the back of a high trading volume. So riding on this latest new bullish momentum, PIE will be going towards 3 ringgit 40 cents and followed by 3 ringgit and 60 cents. Downside support is marked at 3 ringgit. Thirdly, we have Xian Group, a Sarawak-based company. Last Friday, it break past 81 cents on the back of high volume. After the breakout, Xian will be testing the next resistance at 85 and followed by 89. Downside support is marked at 78. Fourthly, we have the Sunway REIT, which are eyeing to break past 2 ringgit and 20 cents. So if breakout happens, Sun REIT will be climbing towards 2 ringgit 28 cents and followed by 2 ringgit and 37 cents. Downside support is marked at the recent low at 2 ringgit and 12 cents. So we have 4 trading stocks this morning. Firstly, the high mobility PIE Industrial, a breakout stock, Xian Group, breakout stock, and followed by Sunway REIT, pending breakout. So I stop here and pass on to Yong on the weekly economic updates. Thank you.
Yeah, thanks, Joseph. Let me share my screen first. Thanks all for joining the call. We are presenting the weekly economic update on this. While we are seeing a very strong inflow becoming to global equities, where we can see that market watcher remain risk-taking mode, where into the FOMC decisions of the rate cuts of 25 basis points in September. So in addition of that, on fourth quarter, we are market expecting another 25 to 50 basis point cut. So not representing relative optimism, we can see that the risk sentiment index is showing that the correlations within US S&P and 500 and also as our own interest sentiment index has weakened over last week. You can see the deviation from here. This is likely due to higher weeks readings as investor pricing the heightened geopolitical tensions over the same period. So what is suggesting by that? We can see that from here that the left-hand side charts and these charts that the Wall Street surge is on the verge of corrections, where we think that the technical readings are suggesting that US benchmark continue show a size of exhaustions, and the past rally could due to the transition markets where they are still remain optimism of the Fed cuts, while further extensions of US-China trade negotiations, which likely on the 10th of November could be on the cards, which supporting to this surge. So on the Fed side, we continue to suggest expect cuts in the fourth quarter, where you can see that market pricing is around 1.6, is between 1 to 2 cuts in December. This is against the prior 2.2 cuts at the start of September. So we can expect that market pricing are continue to discount the Fed cuts and moving toward our one cut expectations on the back of elevated US-centric inflations into 2026 and a more resilient growth over the same period. On China front, we think that the China policymakers has kept their 1 year and 5 year loan prime rate unchanged at 3% and 3.5% last week. So this is in line with our expectations. However, we can see that their bond yields are actually on surge amid a decline in demand. So this suggests that investors are reported to increase their equity-related exposure at the start of the week. So other than that, let's move on to see this. It's a calendar made by our analysts that's showing that currently we are expecting US data coming in jobs, and also consumer confidence on Tuesday, as well as 3 key main data is coming at non-farm payroll and employment rate and the service data. So that's all for my part. Thanks everyone, and I would like to pass on to the next speaker. Thanks.
Thanks, Xian. Morning, everyone. So we have a company update. So we maintain neutral with a target price of 3.95 ringgit. Share price has increased by 5% post results, and this is likely driven by the stock's appeal as a defensive plantation play. So we highlight that Taan has maintained a 50 to 80% payout ratio in the past 3 years, and this is higher than the average of 40 to 50% payout ratio for Malaysian companies under our coverage. So this translates to attractive yields of 6 to 10%. Moving forward for F125 and F126, management is confident to maintain the 70 to 80% payout ratio. On CPO prices stayed strong in the third quarter, and this brings the year-to-date average to 4,300 ringgit per ton. And as a pure planter, Taan directly benefits from these higher prices, and this is reflective in its also share price movement. However, we note that Taan would also be more susceptible. So for every 100 ringgit per ton change, Taan earnings would be affected by more than 10%. So Taan is one of the most susceptible companies under our coverage given its nature as a pure planter. So moving forward, we expect our CPO prices to ease slightly in the next coming months due to the peak output season. On FFB output, Taan maintain its guidance of +6 to +12% year-on-year for F125, and it has also expanded its supply chain to secure more external FFB output. So Taan is now expecting external output to make up about 65% of its total FFP process. And this is versus 59% in the past 3 years. So therefore, we increased our earnings by 6% for FY25 and FY26 and 7 after taking into account higher external FFP output. Valuation-wise, however, Taan is trading at 10 times FY26 PE, which is at plus 2 SD above its mean. We believe valuation is fair at this level, given that the share price is supported by its above average dividend payout. So that's all from me, and I'll stop here. And thank you so much, everyone. Happy trading, and see you tomorrow. Bye bye.